ClearValue Tax and others who say Silicon Valley Bank was bailed out have no idea what they're talking about.
The U.S. government just announced that they will be bailing out Silicon Valley Bank.
Really? Who'd you get that from? The guy at your local post office? How about we listen to the people in the government who actually make these decisions?
During the financial crisis, there were investors and owners of systemic large banks that were bailed out. We're not going to do that again.
And that's why it's not a bailout. The company was not saved, the investors lost their money, the executives lost their jobs, and contrary to what ClearValue Tax would have you believe, no taxpayer money was used.
So essentially, the next round of bailouts, they have begun. And this is going to cost the taxpayers, this is going to cost us billions of dollars, if not more.
More than billions? So it could cost investors trillions? I don't even know what to say to that. But let's focus on the broader point. Who was saved and where did the money come from? The only people saved were the depositors who had their money in the bank. So why save the depositors? Well, think about it this way. Where is your money? If news came out tomorrow that the executives of that bank had made some stupid decisions, do you think you should have to pay for that? No, of course not. This is a key point to understand. None of the people who could have benefited from the bank taking too much risk, like the stockholders, the bondholders, or the executives, are being saved. Only the depositors are being saved. And most of them were businesses that needed that money to pay their employees. Some of the depositors were even payroll companies. If they hadn't been saved, thousands of people who had nothing to do with Silicon Valley Bank could have lost their jobs. Saving the depositors was the right thing to do, and it was a key step in trying to maintain stability at other regional banks and keep this from turning into a bigger crisis. Where did the money come from? The short answer is not the taxpayers. Silicon Valley Bank and Signature Bank were placed into receivership by the FDIC. Essentially, that means they go out of business, the FDIC takes over and starts selling off their assets. Normally, the FDIC just insures deposits up to $250,000. But in this case, they decided to insure all deposits for the reasons I just mentioned. The money used to pay depositors comes from the Deposit Insurance Fund, which is money that the FDIC collects through quarterly assessments on insured banks. It's like insurance that all the banks are forced to buy. And when a bank fails, the FDIC uses that money to save the depositors who had their money there. This was not a bailout, and it did not use taxpayer money. If you want to sift through all the bad information out there on the internet and actually learn from someone who knows what they're talking about, hi, I'm Kyle with Fundamentals of Finance, and I can help you with that.